China's exporters are dumping dollars, the White House is threatening embargoes, and Amazon just got accused of pushing Chinese propaganda for showing price hikes. This isn't diplomacy, it's economic warfare, and Scott Bessent, he just issued an ultimatum that could blow a $25 trillion economy off balance. So ask yourself, what happens when the world's largest consumer market goes to war with its biggest supplier, and both sides think they'll win? Scott Bessent didn't flinch. On live TV, he issued what amounted to an ultimatum. China must de-escalate first, or the US will escalate further. But that confidence may be built on a misread foundation. Bessent argues that China depends on US demand because it exports 5 times more to America than it imports. That's statistically true, but contextually incomplete. According to China's Ministry of Commerce, exports to the US made up just 2.5% of China's GDP in 2023, down from 3.5% in 2018, showing that Beijing's exposure is shrinking. In contrast, the US remains heavily reliant on Chinese manufacturing across critical sectors. And if Bessent is wrong about who has leverage, the entire trade strategy could implode under its own assumptions. But that's not the only fault line. Scheduled cargo volume from China is collapsing. Hapag-Lloyd, one of the world's top container shippers, confirmed that 30% of bookings have been canceled, and projections for May show shipments could halt entirely. According to the Port of Los Angeles, China currently accounts for 45% of its inbound traffic, meaning nearly half its volume is now at risk. This isn't a temporary bottleneck, it's a systemic choke. When shelves go empty, demand doesn't wait. It spills into inflation. With fewer goods competing for consumer dollars, prices don't just rise, they surge. And if you're wondering how close we are to that point, look at what's already happening in electronics, tools, and apparel. Inventories are tightening, and restock delays are stretching from weeks to quarters. So what happens next if US supply chains can't bridge the gap? The 245% tariff slapped on Chinese goods wasn't just high, it was prohibitive. Retailers didn't try to absorb the cost, they canceled the order. According to Reuters, major importers across home goods, hardware, and consumer electronics have halted shipments rather than pay a threefold increase at customs. Bessent claims US retailers had pre-ordered, but pre-ordering doesn't dodge tariffs. They're charged upon entry, not purchase. And there's no workaround. Unless companies resort to smuggling, which is both illegal and implausible, the only logical move is to walk away. That's exactly what's happening. Industry analysts from Bloomberg now project a 32% contraction in Chinese origin imports by end of Q2. This isn't about resilience. It's about what happens when cost structure becomes unsustainable. But here's where the illusion really cracks. Elasticity doesn't mean recovery, it means delay. US manufacturers can't flip a switch and replace Chinese suppliers overnight. Even with Vietnam ramping up production, transport costs from Saigon have risen 15% month over month, and tariffs on Vietnamese imports are currently 10%, with a scheduled increase to nearly 50% once the 90-day tariff pause expires. Substitution isn't solving the crisis, it's inflating it. JP Morgan analysts estimate that supply substitution strategies are now 20% more expensive on average than pre-tariff Chinese imports. In practice, that means higher shelf prices, lower margins, and deeper strain on consumer budgets. Meanwhile, US manufacturers still depend on Chinese components for pharmaceuticals and auto parts. If there's slack in the system, it hasn't shown up yet. So what's Bessent really counting on? Bessent's logic rests on a controversial economic claim. Deficit countries win trade wars because they import more. They need us more than we need them, he stated. But historical precedent complicates that view. During the 1980s US-Japan trade standoff, Japan, despite a trade surplus, weathered the escalation longer due to tighter capital controls and diversified markets. Today, China has built a parallel strategy. Its Belt and Road trade corridors and yuan-denominated oil contracts have reduced its exposure to U.S. disruptions. By contrast, the U.S. consumer is highly exposed to foreign volatility. A 2024 study by the Peterson Institute for International Economics found that U.S. households bear 92% of the cost of tariffs via higher prices, while foreign firms adjust pricing only marginally. So if Besant is wrong about China's breaking point, is he also misjudging America's? The numbers paint a clear direction. In 2018, China's exports to the U.S. totaled $478 billion, accounting for 3.5% of its economy. By 2023, that fell to $420 billion, or 2.9% of GDP. Current year projections show another drop, with bilateral trade volume expected to contract another 12% by year-end. That's not collapse, it's insulation. Meanwhile, China has increased exports to Southeast Asia and the Middle East by 22% in the same period, according to customs data. The dependency argument loses force when the pivot has already begun. The danger now isn't that China collapses, but that it adapts faster than the US can react. And if so, the consequences will land stateside first. But just how bad could that fallout get? When Besant hinted at using his escalation ladder, he framed it as a last resort. But the implication was clear. The United States is considering embargoes on specific Chinese goods, possibly including aviation parts and tech components. If enacted, these moves could trigger retaliatory bans and paralyze sectors that rely on bilateral flows. According to the National Association of Manufacturers, over 37% of U.S. firms depend on Chinese-sourced inputs for core production. Blocking those goods wouldn't weaken China, it would stall U.S. production lines. And, Wall Street is noticing. Goldman Sachs warned that aggressive embargo strategies could shave 0.9% off U.S. GDP growth if enacted in the third quarter. But this isn't just a forecast, it's a fuse. And one economic signal suggests the explosion may already be underway. The Atlanta Fed's final estimate for first quarter GDP stands at negative 2.5%, marking a sharp reversal from the 1.6% growth in the fourth quarter of 2024. That figure, if confirmed, would place the United States halfway into a technical recession. Analysts at Bloomberg Economics cite weakening consumer demand, tariff-driven price hikes, and shrinking business inventories as primary contributors. The trade war is no longer a geopolitical headline. It's a measurable drag on economic output. And with $514 billion in new federal borrowing planned this quarter, per Treasury Department data, fiscal room to maneuver is vanishing. Markets are already reacting. The 10-year yield spiked to 4.52%, while mortgage rates hit 7.1%, choking credit-sensitive sectors like housing. The U.S. economy isn't on the brink. It's tipping. But what happens if Besant pushes one step further? The exodus from the US dollar isn't being led by governments. It's coming from Chinese exporters who no longer see holding greenbacks as rational. As the yuan strengthens and the dollar loses ground, companies earning in US dollars are accelerating conversions to renminbi to preserve value. According to Bloomberg FX data, the dollar has fallen 5.7% against the yuan since late March, despite Beijing's efforts to weaken its currency. That trend creates a clear economic incentive. Hold dollars too long and you lose money on conversion. This isn't retaliation, it's risk management. Exporters are watching the dollar's purchasing power erode in real time and choosing to cut exposure before the decline deepens. But that currency rotation is now feeding a larger instability. This time, the threat to the dollar isn't coming from central banks, but from exporters emptying their U.S. accounts. As trade-linked cash flows exit U.S. assets and move back into local currencies, the pressure on the dollar intensifies from the ground up. April data from the People's Bank of China shows a $23.8 billion increase in cross-border yuan settlements, driven largely by private sector demand. And it's not just the RMB. Japan's yen and Switzerland's franc have also seen sharp gains as exporters reallocate reserves. According to Reuters, even the Russian ruble, despite sanctions, has gained 38% against the dollar since February. This is not speculative positioning, it's operational survival. And once that behavior becomes normalized, the dollar's erosion stops being a trend. It becomes a structural decline. But that erosion isn't isolated. It's bleeding into policy, pricing, and perception. The tariff war went from abstract to personal when reports surfaced that Amazon might label product pages with real-time tariff impacts, showing exactly how much Trump's policies were inflating prices. While Amazon later walked it back, the political response was swift and unhinged. In a White House press briefing, the move was called a hostile and political act, and officials accused Amazon of partnering with a Chinese propaganda arm, a claim presented without evidence. The shift in narrative signals something deeper. Price hikes are no longer theoretical. According to the American Apparel and Footwear Association, tariffs are already adding up to 35% to final retail prices on key product categories. The trade war has officially reached the consumer checkout line, and the administration's reaction suggests they know it. Behind the bold rhetoric, Besant's strategy now depends on a theory that may be unraveling, that China's economy will fold under pressure before the United States consumer reaches a breaking point. But the data tells a different story. A 2025 report from the National Bureau of Economic Research found that 62% of U.S. retailers still rely on Chinese manufacturing for more than half their inventory. If China stops exporting and the U.S. economy continues slowing, the strategy flips. Pressure boomerangs back to Washington. So what happens if the bluff is called? The supply chain damage is no longer speculative, it's baked in. According to S&P Global, U.S. container imports from China dropped 29.8% year-over-year in April, and logistics forecasts show no rebound through Q2. Major shippers like Maersk and Evergreen are slashing U.S.-bound sailings, citing irrecoverable losses in volume. Retailers aren't waiting. Home Depot, Walmart, and Target have already cut advance orders from Chinese suppliers by over 35% compared to the same period last year, based on Port of Long Beach booking data. And the ripple isn't just on the water. Warehouse backlogs are shrinking, inventory lead times are stretching, and small businesses are reporting stockouts across multiple SKUs. Whether or not Besant escalates further, the damage is already in motion. The shelves may look full now, but the gap in the pipeline is already sealed. If Besant follows through with a full embargo on Chinese goods, as he suggested in his escalation ladder comment, the consequences could be catastrophic. Banning categories like aerospace parts, semiconductors, or industrial components would trigger immediate production stoppages across U.S. industries. Simultaneously, reciprocal bans from Beijing could cut U.S. companies off from rare earths, solar panels, and key electronics inputs. Wall Street is already pricing in the risk. Goldman Sachs' trade exposure index just hit a 9-month low, and Fed economists now estimate a 70% probability of recession by Q3 if escalation proceeds. Besant may have issued the threat thinking China would blink. But the real question isn't whether Beijing yields. It's whether the U.S. economy can survive its own red line. So here's the question. If Besant doubles down, who folds first, China or the U.S. consumer? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.